This is Justin Pulitzer. This is my weekend review video for Sunday, July 31st, 2016. As usual, I'm going to start out with my six, really starting to become seven Fed market keys, and also talk a little macro. I'm going to get the macro done first. The week prior, we had the Philly Fed, big miss. Not good economic numbers, and then that was kind of compounded this week with weak GDP reads with revisions down, and I think that got people to believe that we're back into the lower for longer camp. Initially, we had a Fed decision this week, kind of went, I guess, relatively unnoticed, but there was some initial chatter that the Fed was a little bit more hawkish. They had added in some new language. They were saying that the recession risk I read it as the recession risk diminished. They said global risks diminished. I think that was really just a recognition that the last couple of reads. Keep in mind that these some of these Fed heads are a little bit. They're always looking at yesteryear numbers. And the last employment read was stronger. I've discussed my beef with the employment number in the past. That it really is the beat was really a seasonality. I've talked about though, and also part-time jobs. You know, the waiters, waitresses, bartenders, and of course it's summer, so we've got those carnival ride operators. So there's no wage growth, and these aren't like career type of jobs. The big fear always with strong employment numbers is that there's going to be pressure on wage growth. I think I've demonstrated to you guys and gals over time that we are living in a new age. It's very different from the past. There's automation and artificial intelligence, and a lot of the jobs that have been lost are just never coming back. And if anything, the price for that labor or that technology is going down, so there is no pressure on wage growth. I think the Fed is sort of coming to this realization, although I don't know if they'll ever admit it publicly. I've heard Janet Yellen kind of hint at it. I just don't think that that's baked into their models that they've been using for decades, and I think that those models are all busted, like the 7-year business cycle and so on and so forth, because of, ZIRP and NIRP, which is zero and negative interest rate policies. Anyway, let's get into those six market keys. I wanted to start out with discussing a couple of polls I did. These were done on Twitter, some proprietary data I've been collecting. I've been trying to utilize the poll feature and figure out how to best use it. I often use it for earnings as a bit of a Costanza read, meaning if people are overly bullish, I do the opposite. Or I know if the stock does move in that way, that, like in the instances of Facebook, that there could be a fade because people are all basically playing long and need to book some profits. This is a little bit different, though, my take on the overall market. I did two polls. The first one said, in general, are you bullish or bearish? And, of course, I used the cash tags for SPY and for the S&P, the cash index. And this came back a little bit more bullish than it's been in the past, 64%. Versus 36% bearish. And I was starting to think maybe people are getting a little bit more bullish. But I decided to run it again. And I wanted to do it, and I wanted to add in this term, this neutral. And these results are very different. You can see less than half the people here are still bullish. And you have about a quarter of them that are neutral, and a little over a quarter that are bearish. And if you add these up, this is still under 50% of people bullish. So what this tells me is that a lot of these neutral people probably here answered bullish, meaning that they're waiting to buy the dips, so that there is some underlying bids to the market. That's just my take on this. So I think things are starting to get more bullish, but I still think people are not believing the rally and they don't want to pay up. And there's no real chase yet. So that's my take on the data, that people are still skeptical. We're well under 50% here once you add in the neutral category. And I believe that there will be people still in buy the dips mode. So that's my take on the data. That leaves us with a conundrum here. We're in the lower end of the VIX range, which we know here means purely directional play, meaning we're buying calls or buying puts or spreads and so on and so forth. Premium is cheap, so we want to be buyers more than sellers. We can see that there sort of is a floor. The VIX will never go to zero. There's always sort of an asymptotic relationship with, or I should say a zero-bound relationship with basically 10 to 11. I think in 2007 it undercut 10, and that was sort of the absolute peak of the market. So if we are always on the lookout for an undercut of 10. If that happens, you probably want to start layering into some SPY puts, but we're on the lower end here. And that to me just means that we could be in one of these phases where we're just kind of seesawing in range with these momentary spikes of panic, to get the IV, I guess the blood flowing. But I think that this could just be one of these more summer lulls. We're through the presidential conventions, both the DNC and the RNC, very different visions for the future, but that's not going to play in until later on in the fall. So I think this is sort of just the status quo. I am a little bit concerned that if you look on the stochastics that we're kind of in the very low end of range, and this is starting to bend up a bit. But that doesn't necessarily mean that it's, off to the races. It just means that it could be pinging in that range. But we are purely directional here. We are at the lower end of range, so we are cautious, remaining vigilant. The Fed statement, I don't think anything could have been more emblematic of the lower for longer than the reaction on the dollar. You could use DX, you could use the UUP. I've been using the UUP, so I'll kind of just stick with it. I talked about the dollar rising. I said we were coming right into the kind of the must hold. I shouldn't say must hold, but I should say the must not cross area for the bulls if they wanted to keep the S&P going well. And it basically stalled right at it. The high here was 25.23 to the tick. If you look over here in this high level area, the high of this move was 25.23, which tells me my levels are still accurate. And you can see we had this reversal. This high here was 25.22, a bit of a lower high, and once we lost that range, it was not good. There was a little bit of a move down on Thursday, but Friday I think was when everyone finally, I guess, watched my Periscope video and realized that we were in the lower for longer camp. We are now right into the 100 MA though. This should be some support. We did close below the 50. There's room a little bit lower in the dollar, but it's good that for anyone who's long in terms of, I should say long in SPY terms, it's good that the dollar backed off, because if the dollar is rising, and that means corporate profits are falling. I always talk about my simple division problem and the PE multiple premiums. A rising dollar does lower that numerator, that top number. We're going to get to that in a little while when I do TLT next, so just keep that in mind when I talk about the top number. A rising dollar, bad for the top number. A falling dollar, good for the top number, meaning the earnings there are higher. So that's the deal with the dollar. As long as we're not in a rising phase and it doesn't get through this area, there's sort of not that much to see. Once we start clearing this range, it starts becoming a little bit more troublesome. Speaking of the devil, the bonds, the TLT. So it's very interesting to watch the media and I guess less initiated traders, although some of them have been trading a really long time, and honestly, they should know better. Maybe it's just been too long. They've been out of finance class too long. So the deal with the bonds is this. I talked about my simple division problem, the numerator and the denominator. So in discounted cash flow valuation, DCF, and I'll provide a link for that. I've been doing that in pretty much all my videos. If you look in the description below, I post a link to my alma mater at NYU. They have a really nice little website with formulas and stuff, and I picked the one out for the weighted average cost of capital, which is which is basically the discount factor for DCF valuation. And a very large component of that is what is known as the risk-free rate or treasury rate. And we all know that if that number is, I shouldn't say we all know that, but we should all know that the lower that number is, meaning the denominator, the number that you divide the top number by, as long as that number is low, the end product is higher. Meaning the higher bonds go, or as long as they just stay high, that interest rate is a low number, meaning we have a larger end product, meaning more of a PE multiple premium. If we get in a phase like this where the interest rates are rising rapidly, we then would, I guess, start to remove some of that PE multiple premium. Just for context, I love showing this chart because it's just so mind-boggling. The end of the world was 2009, and TLT was at 123.15, and it spiked, came back down. We are living in a new world up here at these highs. Bonds are making higher lows and higher highs, you can see. So to me, that just means that interest rates are likely staying low for a while, and they don't even necessarily need to be screaming higher. They just kind of need to be sideways and just not going lower. Even, little pullbacks, relatively speaking, like this, still mean the lower for longer thesis is in play. We didn't even get a full measured move pullback here to a 50% fib, which I think shows just how much demand there is for bonds. In Europe, there is no FDIC insurance. Very wealthy people start worrying less about a return on their capital, rather they want a return of their capital, and I believe that they are basically seeing a stable to rising dollar and a situation in Europe where they have negative interest rates, meaning if you look at the German bunds, you're basically paying for keeping your money in Germany. Now, I don't know about you, but I'd rather have my money in the United States than backed by the full faith and credit of the U.S. government than, the full faith and credit of the German government. So, and you're getting yield for it. So I guess it's sort of, there's that arbitrage going on. People are selling their, foreign currencies and they're buying into the U.S. treasuries. So this is the lower for longer. As long as the bonds stay high, the PE multiple on the S&P will stay high. The first place that we would start really seeing some trouble would be in the HYG. This is not at an all-time high, but it is pulling back kind of gently. I believe a little bit of this is because of the oil situation, right? We know that oil has been in pullback mode. I'll get to that in a moment, but the fear is that you had a lot of companies that have a high cost of production. I believe a lot of them have hedged it off when oil got back into the $50 range, hence why it's pulled back so dramatically. But you can see the 200 MA here is held pretty much like a champ with some brief periods of time below there. And since we've gapped over the 50, we've never really lost it with too much conviction. So a gentle pullback in HYG to me is okay as long as we're kind of holding above this upper distribution. If we got much past the 83s, I would start getting a little bit more concerned. So yeah, this is just what you don't want to see, this kind of amphilotic, protracted declines in the high yield market, meaning high yield over treasuries. This got into a down channel, and it is kind of just riding that area. It's now back below a smidge, but until this really starts breaking down, I'm not going to put too much, get too worried about it. A bit of poor highs, very easy, gentle back off so far. If this starts to form a trend, a downtrend, meaning we're making lower lows and some lower highs, then we may have to start paying more attention to that. Right now, it's just a a blip on the radar, but we will always keep that in mind. Oil, I talked about getting to the 200 MA. We did it. This is very key. We could be forming a secure low here. Protracted decline, low bookend. A low with excess bookended now by two higher lows. Oil has gotten oversold. We're below the channel low. It would not surprise me to see it bounce multiple days down. If this doesn't wind up being a secure low, then I think we're talking about some of the fib levels, the 38 level and 38.86, which is a half back, and then maybe the 61.8 at 35.84. I don't necessarily think that that's going to be the case. The Baker Hughes rig count came out this week, and again, it was a rise. There's more rigs being put online, but the rate of change, which is always where things start getting interesting first, that would be your gamma. That is shrinking, so there are less new rigs being put on, and it's starting to flatten out. So in that scenario, oil would be more stable to rising. So we'll see how that plays. I will say this. If we can hold the 200 here, that would be better for the market. I know a lot of people are saying the correlation between oil and the market is broken. I don't believe that it is broken. I believe that it is maybe weakened a bit. The correlation is lessened, I should say. So I don't think it's gone. I just think it's lessened a bit. That should be evident by the inability here for the market to really break out. I don't think it can really just do it without oil. So let's keep an eye on this 200 MA. Above the 200 MA, we're hunky-dory, so to speak. And below it, we are more cautious. Very simple. Keep it simple, stupid, right? XLE, powerful reversal off the 100. Didn't even quite get to the 200, which is, to me, better. Because if you look on a longer dated chart, once we lost the 200 here, it never got back over until the breakout here. And it's never really retested. So I would be a buyer of this on the 200 and probably in size for RORO, meaning right or right out. But right now the 100 seems to be our, I guess, champion. And we can use the 100 here. This is a pretty dramatic bar that you had now multiple days below the 50. If you can hold the 100 and clear the 50, I think things are better. Below the 50, we're going to still remain a little bit cautious. You can see the 50 had been holding like a bit of a champ. This looks like some back test. If we can't clear the 50, then we're going to be a little bit more cautious. Exxon. So Exxon got near the channel high. I talked about this being an area to lighten up. It had a pretty protracted decline, broke the channel on earnings, and basically closed near the high of the day. Yeah, very simple. We got into some, I guess, a little bit oversold territory short term. We are, again, below the 50 here, which has me a little bit, I should say, a little bit more concerned. There could be room for Exxon if this loses this bar to fill up all the way down to like 82, maybe 81. I think between 81 and 83 will be the floor in Exxon. Famous last words. The channel low is really down here in the 68s currently. I don't really see this coming, though, from all the way from the channel high, selling off, reversing on a really crappy earnings number, and then just completely falling apart. So I think Exxon might be choppy for a little while. There's still some time in the stochastics. The money flow index is first getting close to oversold territory, but we could use this range here as a really good guide. I like this 87.44 level. It's also right below the body of here. It's good that we held it. Anything back below that level, 87.61 to 87.44, I will be more cautious on Exxon. Anything above there, it could easily fill the gap and come back up and, at the very least, in my view, make a lower high before it's in super-duper danger. It's very rare for stocks to come from a 52-week high, come down, and then just continue to completely roll over without first rallying to at least a lower high. That lower high could be a gap fill and the backside of the old channel, where I would use that opportunity for a right or right out short, and then kind of just test the waters and see how that goes. It would be even better if it coincided with the 50-day moving average. Longer term, I think Exxon goes higher, but short term, it could pull back a smidge more. Again, just let's go by the levels. 87.44. Above is okay. Below is not as okay. All right. China. Gotta have your China. 200 MA was very hard to sustain over. It is through. I'd be looking for the 200 and the 50-day moving average confluence now to be some strong support. It just seems like it's chopping to me in a channel, and I do think eventually it wants to work its way up to the channel high. The breakdown level is up here, so I think 36s to 37.66s could be a bit of resistance, at least initially. If this does wind up pulling back, I would be a right or right out buyer on that moving average confluence. IBB is starting to wake up. That's a bit of a risk on indicator. I do want to caution a couple of things, though. First and foremost is the breakdown. This kind of false breakdown happened after coming down from the top of the range, and now we're breaking out after coming up from basically the dead low of the range. So it's come a long way very quickly. It is basically into reference highs. I think this could pop a little bit more, get more people excited, but I would be looking to buy a dip here now more than chasing, just because it's come so far so fast, although the path of least resistance here seems to be higher. The 200 MA has held. Look at this. It had a look up, a look below the 200 and fail, a look below the 200 and fail. I would be using these pullback lows, if you're long, this 283.82 as your stop. Anything back below these kind of pullback, these failed pullback lows, to me could be a bit of a rollover mode back into the middle part of the range. But I do like that it's breaking the wedge. I do like that it's coming up, but I'm a little cautious just because we've come all the way from here. If you were astute and bought on this breakout, probably good to, as I always say, trim and trail, meaning take some profits and trail up stops. If you want, you can also use this new trend line as your guide. Above the trend line, above the breakout is good, below is not so good. Alchemies, they reported earnings. It ran up into the into the earnings. As you can see, we're well off those old lows. And I've been looking for a retest of the 54.54 and maybe a gap fill up here in 60.25. The key to me here is the 200 MA. Look at the resistance it was here. We got through it. Now we'll look below, and here closed basically just on it. So for me, for alchemy, is above 50.06, which is the high of day of the pullback bar, I believe remains a long. Below the 48.28 is a little iffy and probably a short, or at the very least, you don't want to be as long, because to me this would be a failed 200-day. You see it pulled back, and now we're below it. Now we're just barely over it. 200 MA really key. We could use this pullback bar, this sort of harami bar, as our range guide. A move below these lows, I think it's the 50 MA and the channel low fast, and then in that area I probably would be an interested buyer, maybe even a put seller. Let's get into the market itself. SPY. All right, so SPY has broken this down channel here. It's actually could be. I'll leave it as is for now, but it really could be grayed out. And we've rallied up really strong over these highs, and we are now basically chopping around the 1.272 fib extension from this high to the range low now up here. I believe we want to see the channel high it didn't coincide with. I just had drawn this in speculatively. I didn't really know when and where it would happen, but it would have been cute if it coincided with the channel top and the 1.618 fib extension. So who knows where that could be. I'll just move it out to here, just arbitrarily for now. But we've spent a lot of time going sideways, working off this run. There's two ways to have a correction. You can do it by price, meaning pullback, or you can do it going sideways by time. These highs in here are very poor. This is really not a lot of excess. I mean, Friday you did have a bit of a smidge look, but we're basically in a tight consolidated range. The question is going to be here, there's a few scenarios that can play out, and I can't tell you with certainty which one will happen, but I can kind of discuss here how I at least will be playing it. The options are obviously more chop and more consolidation. There's the opportunity for a look above and go, meaning it gets above this range and continues. A look above and fail, where it comes back into range and then goes lower. A look below and go, where it means gets below the range and goes. Or a look below and fail, where it comes down like a little quickly and then goes and rallies back higher. Given where we are in the VIX range, I am cautious for the kind of the look below and maybe fail and then go higher type of a scenario. But let's keep it really simple. I like this bar because it kind of really defines the edge of the range. Anything below 215.31, I would be very right or right out for a short. You could even use these lows since they're more near dated. Anything below 215.62, I think you could try for right or right out. For a pullback, maybe to retest the breakout area in the 213.78 to 212.52-ish area. This would just kind of be one of these. Or anything above these range highs, though, 217.37, to me, really continues the rally on, considering we've had multiple days of consolidation. It's much less overbought and could rally up and see the 1.618 and maybe even the channel high. So I'm just really going to go where the market tells me and where the range tells me. I guess you can say that there are feathers in the hats of both the bulls and the bears. But first, for the bears, I would say that what I think they have going for them is that you've had a lot of big momentum stocks that have had very large moves higher, and it hasn't been able to definitively break the market out higher. That I mean with Apple, Facebook, Google, Amazon. All these stocks moved higher. These are the big Nasdaq-weighted, stocks, the momentum names, and they haven't really been able to take the market higher. So it's sort of what now? If market can't go higher on great earnings, it probably is going to want to pull back and go lower. For the bulls, the best thing I would say that they have going for them is that those stats that I said, that there is still a lot of sideline money, and there's still under 50% of the people when you factor in neutral that are bullish. So it's not a widely participated in rally, in my view. So I would say I err on the cautious side, just because we've come so far so fast and there hasn't really been a pullback. But I would be very surprised, even if this does pull back, if these highs are the end of the rally. I think that we will see higher eventually at some point. IWM. Let's go back to SPY quickly. I think I gave my levels. If this were to break, I'd be looking for a move back to the 212.52 to 213.78. If this rallies up, I'm looking for the 221.09. Real simple with that. The expected move this week is a little small. I have to take a look. I should have had that ready for the video. For some reason, I don't have it written down. It'll be when you're watching this video. I will post it in this part of the chart. It'll be in the upper right. I'm going to add it in post video. IWM. All right, so this is a bit of a doji here. This was a bit of a look above, and I wouldn't say a look above and fail, but it's just sort of chopping in range. If we go back a little bit longer, 1 year daily. No, I want to go back a little more. 2 year, I think, should do it. you can see we're basically coming into these breakdown levels that were referenced in the IWM. I do like that this is sort of riding the 10-day moving average. So if you're quick, you can use the 10-day as your guide. Anything that remains above the 10-day to me remains bullish. If it breaks, maybe it sees the 20 and possibly even the 50 if we get a bit of a decent-sized correction. But as long as it's riding the 10-day, it can keep riding and just kind of mosey its way higher. This transition from a down move now to an up move. So again, looking to be a BTD type of guy, buy the dips. If you didn't catch this, I don't know if you necessarily want to chase for the last move, but I don't know that I'd want to be short for it. I like above Friday's high long, and I like below Friday's low short for a quick trade, quick time. Amazingly, we are not at highs yet in the Nasdaq. I'm going to just draw this in. I didn't have it in at the moment. 75, right? So we're coming into some reference area. We've come up quite a way. There could be some reference selling here. It could always break through and get to my end target of the 124.51, and that would mean that you have Apple participating. I'm going to talk about Apple in a minute, and one of the things that actually has me a little bit more positive on the market is Apple. Let's, though, keep it simple with levels. Above the 115.75, I would initially maybe look to book a little bit of profits just because it's come so far so fast, but can't argue with new highs. We're still in BTD mode in my view. A lot of people I think could say might be a double top. Doesn't have that look and feel to me. If this does pull back, I think that this 111s area, maybe to 110s, would probably be, what was the high here? 110.75 to 111.86. I would think that level, it'll probably coincide with the 50 MA by the time we get there, would probably be a good idea to play put ratios. You buy like some puts here and then sell 2 times out of the money here, short dated. But there might be some resistance here, some reference resistance, but the Nasdaq is looking like it'll probably, at my view, at least test above that high. The aforementioned Apple. So Apple, there's a couple of ways to look at this chart. You can draw your downtrends, and I know this is a little bit messy. I drew in this head and shoulders pattern that it had. This was sort of the failed check back, and it just has been meandering around these lows. These 92s kind of held. You had to look below and fail. Now a higher low, and now we're above the range. Apple gapped on earnings. This was a bit of it. It came into the 100 area twice. It pulled back, which is what we like to see multiple days. I talked about the lower this presses, the better the setup would be. And you had a gap and a hold now for 3 trading sessions. A couple of things to pay attention to here. One is that if you're a purist and you draw a trend line connecting these highs, Apple was a gap and hold above the downtrend. If you choose to ignore this high and go straight to this high, Apple is basically just holding right under it and threatening to pierce above it. You can see when Apple broke the 200 MA, it was able to kind of rally back up to it, but couldn't spend a lot of time over it. Again, here, not a lot of time above it. They were failures. Here, it is spending now time above it. You can see also on Friday that, first of all, the first day was a gap, and people basically sold it off. They, I guess, took profits. A lot of people had played long. The next day, it rallied back up and was right to the highs. And then here, you have a bullish doji that stopped right on the 200-day moving average and closed up near the highs. I think Apple looks bullish to me in this sense that it's able to now it's holding the 200 MA, is above one of the downtrends, and is basically, if it can get over the 3-day high, will be above this downtrend. When a stock gaps above a downtrend, and above a range, and this is all this range, that starts to me looking more like a professional gap, meaning the gap that initiates the next leg higher. And you can see we have a gap to fill in Apple still from that Tokyo down, that Nikkei downgrade that led into the sell off here ahead of earnings, and then Icon said he was out, it went lower, spent a lot of time in the wilderness here, and now is starting to look like it wants to break out. I would say this. Anything above the 3-day range high and the 200 MA, you can use the 200 MA. You could, even if you're really quick, you can say long above the 200 MA and flat or short below it. I really prefer the 3-day range. Anything above the 3-day range I think is bullish, and we'll see the 109.85 to 110. Anything below the low, the 102.75, to me would look like another failure and would likely fill the gap down to, I don't know if it's going to get all the way down to 96, but I do think that it could get down to 100 rather quickly. So I think that the play is either long above the 200 MA, flat below it, or short below these lows. I'm going to keep it that simple. Currently, I have a small long position in Apple. I had played it. I had talked about playing it long on the earnings, and I think that the setup still looks good to me as long as it is above the 200 MA. If Apple does start participating, that should be able to take the Nasdaq, by the way, to new highs. I'll also discuss that when I get to Google. Amazon, stock is just a monster, right? They had pretty good earnings. It did break out of this downtrend. It is basically at an all-time high. It didn't get as big of a move as you would think, so I would think Amazon could maybe be a little bit vulnerable here. If you get below the earnings day low, which was the 755, then I think this would be kind of a look above and fail, particularly if it was a gap below the low on Monday. But I do think at some point Amazon is going to see this fib extension to the 833. As you can see, it's basically riding the channel low and probably wants to just move its way up to the channel high. So I'm still cautiously optimistic on Amazon, but the price action on Friday wasn't necessarily supercalifragilisticexpialidocious. Keep it simple. Anything below 755 is want to be flat or short. Anything above 766, I would want to be more long than short. Facebook, the curious case of Facebook. All right, let's do it. I talked about this being a long for a while. I thought it would see the 1.618 Fibonacci extensions, and it did. It actually was even higher in after hours. It was actually above this line and above the progression line in the after hours action. I had tweeted in real time to book some profits above the 131 because that was above the 1.618 extension, and to use that as a stop. Congratulations to those of you who listened. I think the big problem for Facebook for earnings was that it really hate how this chart looks. This is much better. I talked about how to play this basically to the tick. I said that we would chop for a while, that there would be a likely breakdown to the trend and to the gap fill. I talked about getting long this day. You can go back and check my tweets. And I talked about getting up to here. It worked. The question is, what now? My what now is this, there are two scenarios here for Facebook. One is that it goes back up and retests its after hours highs. Now that a lot of people had played this long with the weekly calls, you always have to think about it. Everyone was bullish into Facebook earnings. They were all in weekly calls, and they all needed to book profits. Or, if it doesn't meander higher, this will continue to pull back and chop sort of like it always does. It could be one of these scenarios where it does pull back quite extensively. But I think that the earnings were really great. I was a big fan. I think that the likely area of pullback here would be the 120.79, kind of the breakout area. If it does get a little bit more, I think it could pull back to the lower end of this range, the 116s. So I think somewhere in this range we'll likely find bidders. I think that's going to depend a little bit on the market as well. If the market stays bullish, it might kind of hold the higher end of the area. Or if it gets a little bit more iffy, could get that 50 MA test and a move to the lower end of that range. Let's keep it again. That's not the tool I wanted. I wanted a trend line. We now have another trend line to use. We can keep that simple. I like the idea initially, if this keeps pulling back, of buying this secondary trend line. Let's call that cautious trend, which is always the yellow for me. If we can hold that, I think that if it continues to pull back, holds the trend, I think it will revisit those highs. It would be perfect if it coincided right with the breakout area for a right or right out trade. If it breaks, then we will think it's coming back into the kind of the end of this distribution. It's either going to stop at the beginning or the end. There's a lot of memory in here. I would likely be selling puts if we got down to here, basically, which would coincide with the trend, wherever that is at the time. So that's how I'm going to play Facebook. If this does wind out being a turnaround, like if you're still long this, 123.63, anything below that to me is iffy. Anything that holds it to me is still kind of okay. So I'm just going to use that earnings bar low as the guide. Anything below those 2-day lows, you can see this kind of tried to rally again and didn't do so well. Anything above those 2-day lows, I think you can try for a right or right out short for a move down there. If you get back above this high here, the 125.84, then I think the game is on for a move to 128s. And maybe an RTH test of the 130.43. Let's use this second day range as our guide. Below the low, short. Above the high, long. Keep it simple, stupid. Twitter, just a piece of you-know-what. It held basically to almost to the tick, one tick below the 61.8. I don't even know why I'm drawing a trend line in here. It's just so not even worth it. I still believe that Twitter at some point is going to do something. It is above the earnings gap day range, which is always good. I think it's just a hold. I don't really think you need to be piling into this. I do think that this will at some point fill the gap, or at least partially fill it. I have a little long in this. I'm not really too happy with it. It's really nothing that's going to make me rich or bankrupt me. But I have a small, long position in Twitter that I've held for a while and just kind of holding. I'm not looking to add. I'm kind of just in it for a little while. Anyway, that's my view on Twitter. This range here is the key. Anything above, it can continue to rally. Anything back in here gets a little bit more iffy, and below the low will likely retest the range lows. So let's keep it simple with Twitter. Earnings gap range day. Start getting through some of these quicker. Netflix. Really not that much to see here. There was some insider buying. It is just kind of still meandering in this downtrend. If you can break the downtrend, this now has a lot of layers of failure in it. Just to me looks like it's consolidating. I would love if this thing would finally, at long last, get a pullback to the primary trend and breakout around the 70 level. It has refused to do so. I have a couple of levels drawn in here. The 88.21, anything below there to me remains iffy. Anything above is better. But more importantly than that, 92.93 has been a really key area for Facebook. For Netflix. It needs to clear there and clear the 50 MA, which is in 94s. You can see, look at all the support the 50 MA had. It was a gap down. I think a retest of the 50 is a good right or right out short. If it doesn't reject, then it will fill the gap up to the 98s. I still see a tremendous amount of, if this gets back to the gap fill here around the 98s, it's probably going to have some reference sellers. We know 103.88 to 105, and now even 108.4 is going to be some resistance. I just, to me, this is a really messy, sloppy chart. I'd rather just not be involved with this for now. The stock is still making lower, kind of equal lows, some sort of equal to lower highs. This is just slop and chop to me. If you can get above this range high, I think you can play a quickie for the 50 MA. A channel break will probably get the gap fill. I do think it will fill the gap at some point, so I don't mind being a little bit long here, but I'm not participating. It's just one I'm taking a sidestep on. Google. It didn't quite get the channel low I was hoping for. We did have a look below and fail. We came from the range low now up to the range high. There is some reference resistance up here. Obviously, people are booking a little bit of profits. It ran into the numbers. However, it did break the downtrend, and I do think that this will this could pull back a little bit more, but I do also believe that this will rally to see this old all-time high. They had good earnings, and I think that it will rally at some point here and see the channel high. That's just my view in Google. I think that this was a large consolidation. It's broken the trend, and I think that it will likely, if you can get above this high, easily see the old all-time high and probably see the channel top. It's just my view. However, and this is a big however, it needs to clear that range, and I think it needs to spend some time consolidating, like I said, because it came from the low to the high very quickly. So I think a few days of consolidation would behoove some Google. It's overbought a little bit now in the stochastics and in the stochastics and in the money flow, and this is just a measure of higher lows and higher highs, but it's a little overbought. I think it would behoove it to cool out a little bit, hold over the 780, which would be good. That was really where this breakdown took place from. So as long as Google pulls back but still holds 780, I think it's okay. And obviously anything over the earnings high a day, this 103.94, I think could power a lot higher. The best scenario for me would be a few days sideways and then go. That is my view on Google. The Tesla. So this is one I've been playing long. My play is basically for a squeeze into earnings, which come on Wednesday. The expected move is $18.74 roughly. It's basically into some reference. It's coming into some reference highs. This was the master plan kind of day. You've had a trend line break. Look at this. It held, retested. It never broke the low here. Equal lows, and has now just been kind of grinding higher. Had a lot of relative strength on Friday. I talked about not playing this with weeklies, but playing it with longer dated options. I've been shorting weekly puts and to offset the price of my longer dated options. I'm looking hopefully to take this off before the number. If it doesn't get the move I want, I might hold through it. I'll do a little bit of an update on that as we get closer. But I would like for this to move ahead of the number to book the trade. As long as we hold the 50 and the 200 here, I was okay with being long. I like that now we're making higher lows and now higher highs. And I think that the stock seasonally is good. I mean, you can see I've drawn in a bit of a potential new channel here. We've broken the downtrend, and I don't know if it's going to see the channel high, but it could. I mean, we could have a $300, finally, a $300 Tesla on our hands at some point. There's about a 30% short interest in the stock, which is really high. 265 has been some resistance in the past. I talked about that trade leading up into the move here. And if we if we were to do a projection, if we had like a similar type of move from the last time, we would have on our hands, that move was 269.34 it topped, and it came from 141.05. So that's 120. $8.90. Hold on, is that right? Yeah, 128.29 plus 187.87 would take you to 316.16 if you projected this move on from here. So look where that coincides with. It's roughly around the channel high. I don't know that that's going to be the case and that's going to happen, but the stock is looking good. It broke out, it consolidated, and it looks like it's going higher. My first target, of course, is the 240.85, and then maybe the 265 to 269 area. But like I said, I'm kind of hoping that we get the move ahead of the number so that I don't have to necessarily play the earnings. I would just love a few strong days up, and then I'd kind of call it a day. But Tesla behaving well, and I believe the path of least resistance, at least short term for me, is it's likely going to be higher. McDonald's, I got a lot of questions on this. This is not a stock I follow that often. It had a high, came down, it now is a lower high, which is not good if you're a long, a bull. Remember when I said before, when a stock like Exxon, for example, comes from a high, it comes down and then at the very least makes a lower high? That's what you really have to be a little on guard for. I drew in this is really where this last leg came from, this 115.32, and the low here was 116.08. I think that this area will hold, and for the first time around, because you did come from quite higher, so I would expect it to come down, bounce, and then maybe go lower. The stock doesn't look great to me. It almost is looking a little head and shoulders-ish, but you can see the 200 MA here was really a lot of key support. It kind of had a bit of a false breakdown, then was supporting again. Now it kind of had a look below and fail, rallied, and now it's just below. So anything below the 200-day moving average, I think, is vulnerable. I don't know if you're going to get the full gap fill, although that really wouldn't surprise me if this head and shoulders area were to break. I could easily see this coming back down into this range, the 192 to 102s. It seems to me like a reasonable, a little bit of a rounded top pulling into that range. But I think the first go round here, these 115 should hold. Maybe it presses a little lower to the 112s, 113s. But I think that this area, somewhere in this area, is probably a buy for the first time. I don't think that I'll be doing that. What I'll be looking is for it to come down here, rally now to, again, a still lower high, and then wait for a reversal, probably for a short. I think McDonald's is just a little overdone here. That's just my view on McDonald's. It was too widely loved. Another food stock is this Whole Foods. It's been really doggish. I know they've opened up a lot of they opened up a big store in my neighborhood. I know it's been pretty busy. It got to a bit of the top of the range. It's now kind of mid-range. These 29 to 31 area has been really very key support for a while in the stock. It needs to hold here. If it gets below, it could easily come back down to these 27s, 28s. I'm surprised that this stock has not had a private equity takeout. I mean, they make a lot of money. It's a premier brand, and it's really not trading that expensively. This to me looks like it's trying to find a bit of a rounded bottom, but there's really not much to see here. I just think one day you could wake up to a takeout in this, but stock has performed very poorly. The 200 here was some resistance. It should have been support. So I'll use the same thing. Below the 200 is a little bit more vulnerable. Above it is better. One I booked profits on, and I'll end here, is this GlaxoSmithKline, GSK. I talked about this being a buy. It's at the channel high. It's at a reference high. I still think the stock will likely go higher over time, but it got my target. It got my target. It got the channel high. I booked it. If this were to pull back mid-range-ish, maybe get a 50 MA test in these mid to lower 40s, I'd probably be a buyer or at least a put seller. I'd like to actually sell some puts in that. You can see the 200 MA here had been a lot of resistance. A retest anywhere in the 200 MA to 100 MA area, I would be a put seller. I'll leave it at that. Anyway, the video is getting a little bit long. I want to cut it there, try to make the video a little bit short. Anyway, that's my story. I'm sticking to it. If you're not following me on Twitter, my handle is @JustinPulitzer. You can follow me there, or you can, if you please leave me some comments. I always like some feedback on these videos. Just hit the comment section. If you liked it, hit the thumbs up. Anyway, let's have a good week, trading week, and cheers.